Welcome back. State pension funds are still underfunded, leaving them short around $740 billion. Here to discuss how that could happen and what it could mean for you is Brent Wilsey, President and CEO of Wilsey Asset Management. Good morning, Brent. Nice to have you on.
Good morning. Thank you for having me.
So these state pension funds, what does this all mean to Californians as we move forward here?
Well, it's a problem across the country, and California is no exception. But what's been going on is that the state pensions have not been funded the way they should. They keep pushing the marker back as opposed to funding. They say, well, we'll do that next year. Well, now we have a problem that they're underfunded. And the thing that's caused the underfunding is that they're just not putting the money in. Also, too, they've overpromised on many things as well. Like, okay, we'll give you this, we'll give you that, trying to close deals. And I got to blame the unions a little bit here because the unions have been, pushing like, okay, we need this, and they don't figure out how long it's going to be. And then they realize they really don't have the money to fund that, but the union contract's been signed. Then also, too, well, fortunately, people are living longer, but that means more money has to be put away to actually handle that. And the sad part is we've gone through 11-year bull market and the state pension funds just were not putting the money in, many times relying too much on the bond market and interest rates. And we've seen interest rates fall through the floor. They used to get a 6 to 8% yield. Now it's about a 1 to 3% yield. So they're having trouble funding those. And unfortunately, what they're doing is they're turning to more riskier investments like long-term real estate and also private equity funds.
Yeah, what is private equity? How does this all relate to these, state pensions being underfunded?
Yeah, and private equity, it sounds like this, oh, it's so cool, private equity, and all you hear about it, like, oh, that's cool. All private equity is it's equity that you don't see what's going on behind the curtain. And the problem with that is that these private equity funds, they're non-liquid, and that's very difficult for a pension fund because sometimes they need that money to pay out the benefits. But when I say non-liquid, it could be years, maybe 10, maybe 15 years before they actually do get this money to be liquid. And working behind the curtain, you don't know what's going on. I'll compare it to public equities, which is what we specialize in. Public equities, you see what's going on. The SEC is on there. They got to do the special reporting. We see the quarterly reports. You don't see that with private equity. You really have no idea what's going on. And they're very highly leveraged as well, which could be a problem because they could fold down the road and you wouldn't know about it until like, well, sorry, it didn't work out. This is why I prefer public equities over private equities. I don't think it should be private at all, but it sounds very fancy. Oh, and by the way, the fees on private equity and alternative investments, they're about 2.5%. I mean, our maximum fee that we charge for our management is 1.5%. It's crazy what they charge, but again, they get away with it because a lot of things are behind the curtain. And I don't think that the public pension plan should be taking the risk to go into private equity.
So what is one to do? I mean, what is the forecast here in your opinion?
Well, the forecast is they have to wake up and they have to start doing more to look at, okay, we're going to invest in good equities. And there's good equities. We do this in our firm that you can buy your food companies, your insurance companies. We know they'll be here and they can get decent returns down the road. But just like I tell our investors, you can't panic when things go down for a bad quarter, even a bad year. You're looking out, pension plans, again, 5, 10 years. So be patient. We tell our clients, you're going to have losing months, losing quarters, losing years, but you'll do well longer term. And the kicker here, Liz, is the problem that they have done is they've got all this extra money come in. I mean, states are flush with cash. Maybe they have more revenue coming in than expenses, and they're not spending it on the right thing. They're giving now some states long-term tax breaks, stimulus programs. This is the time to have all this cash. You should be catching up on the pension plans because people have worked 30, 40 years. They're relying on that pension plan. The states have an obligation to put that money in those pension plans. So when people retire, it's there. It's a very sad story that they've not done this. And we know that probably in a year or two, we could have a recession. Receipts will go down. And then they're really going to be in a hard spot. So it's just a very concerning thing for me that the states have not kept up their promises on these pension plans.
Yeah, you're saying that the more money is being spent on stimulus, refunds, and tax breaks instead of going into the funds.
Yeah, they're not keeping up their promise to put this in the fund, which is a shame because, oh, we'll do this. And they've got all this money. It's like the drunken sailor where they have all this money and they go spend it on having a good time versus taking care of the mortgage and the food and everything else. I mean, states are not very responsible. This is very important for them to fund those pension plans, and it should be a learning for many investors because you don't want to be investing in private equity. You don't want to be investing in these alternative investments. Public equities work very well if you understand how they work and you don't panic because, oh my gosh, I lost money this quarter, this year. That happens investing, but you got to look at what you own.
Yeah, yeah. And if you don't understand how private equity works, that's where people can call folks like you, the experts who can explain all of this. Brent, thank you so much for taking the time. I know there is as much to talk about in terms of our current state of affairs in investments and where we are today as a whole. We appreciate your time. Thanks.
Well, thank you for having me.